Hello and welcome to the financial edition of Ottawa Experts. My name is Andrew Bradley, and tonight we are talking about income taxes, and we're going to be covering some tips and strategies and how to reduce them and minimize them. I just want to let you know ahead of time that any advice given on this is in general nature. If you do have anything specific for your situation, please contact an expert yourself and sit down with them. So joining me tonight, I have Bruce Donelly. He's president of Dion, Vallee Income Tax and Bookkeeping Management. Thanks for joining me.
Nice to meet you, Andrew.
And next to him is Gord Henley. He's a CFP and owner of Henley Solutions. Thanks for joining me. Thanks for coming. So first thing I'd like to kind of talk about is just some kind of income tax myths. People start talking about doing income taxes. There's always, I heard this person did this, I don't need to claim that. From your kind of point of view, what are kind of the most common?
One of the most common ones that we encounter is people who have a small business work from home and say, well, I can claim almost anything against my small business income.
Yeah.
Yes and no. There are some things you can claim and there are some things you cannot, but it has to be reasonable in the circumstance. And what is reasonable is subject to the particular circumstances.
Right.
So, for example, if you have a small business that's like a small construction company, trying to expense the amortization on a 30-foot yacht may not be considered reasonable.
I guess not, eh? Is there anything else too that comes to mind besides business expenses, like in terms of personal?
Employment expenses. People get confused when they wanted to try to deduct stuff that they would reasonably think is deductible, like work clothes. People who work in a nursing environment want to claim their uniforms and they can't, and they get a little bit confused. Go, why can't I claim them? That's why the CRA has a new credit that's called the employment credit, and it's intended to cover some of those expenses that you can't claim.
Okay.
But it's been a pain in people's sides for many years as to why I can't claim my work-related expenses.
Exactly. Why some are, some aren't. It's kind of a great.
It all depends on your employment situation,
Exactly.
whether you're a salaried employee, whether you're a commissioned employee, or even if you're independent contractor.
Right.
So they're all different rules for different situations. But as a person who works for an employer, you have very limited deductions in that area.
Right. Okay. Gord, what kind of, in terms of clients when they speak to you, what kind of tax misconceptions in terms of handling their money? What is there? Anything kind of sticks out?
There's a few. I mean, I'll go right back to the initial engagement. This would be not someone who is a client, obviously, someone who maybe was referred to me on a tax question, and something common I'll get is just, how can I save on my taxes?
Yeah.
And I'm expected to just fire off a magical answer. And what I do tell people is, like, regardless of whether you're going to talk to a CFP, whether you decide you would like an accountant to help you with it, you really are going to have to spend some time to actually go through your situation and even make sure that you understand your situation, because the advice that you're going to receive from the professional you eventually seek out, it is going to be one of those garbage in, garbage out scenarios unless you take a bit of time. If you are looking for a quick fix, I don't know about Bruce's experience, that doesn't generally exist in the world of taxes. They are relatively straightforward if you do that preliminary work, though.
Okay. In terms of someone that doesn't have any income, should they even file a return? Do they need to file a return?
You only need to file an income tax return under circumstances where you might conceivably owe money, or you want to claim the GST, or you have some credits that you'd like to apply. Even if you have no income, for example, tuition credits, you'd like to report those so you can accumulate your unused credits. So while you may not have an immediate requirement to file, there's always good reasons to file.
Okay. And you bring up the tuition credits, like we talked earlier before the show about the situation with filing or claiming tax credits. Maybe you can just share with everyone exactly what you...
We see this quite often with tuition because it can be a little bit confusing. Typically, the parent will pay for the tuition, or they'll go through some kind of financial assistance, but the parent wants to claim the tuition receipt because they paid for it. But in fact, they can't. The student has to claim it. And now the student can claim up to $5,000 whether they're unused education and textbook credits for the current year. They can't use their unused credits for the previous year, just their current credits. And there's an equivalent provincial credit that goes with that as well.
Okay, yeah, it's very important to. It's not just a very cut and dry. Have the credits, claim it.
And it has to be done correctly.
Yeah.
And that unused credit balance is tracked on your CRA file.
Right. Okay, perfect. So we do have a caller. We have Andrew on the line. Go ahead, Andrew.
Hello, is this, are we on here?
Yep, go ahead.
Hi, I was wondering if I could comment on a couple more of the, if you had more examples of the myths you were talking about at the beginning of the show.
Okay, so you like to have some more, talk about more myths? Okay. I kind of do have a list, but I mean, I don't want to sit here and read a list about myths, but...
well, we can run a few off
yeah,
if you want to try a couple.
I'll throw some out there and we can just talk about it. Maternity leave income is not taxable.
Myth.
Myth, eh?
It's unemployment insurance benefits. It's taxable.
Okay, perfect. RSP contributions does not have to be reported if I do not use a deduction.
You don't have to, but you ought to.
Yeah.
And I'll add on to that. A lot of people get confused into thinking that they have to claim it in the year that they contribute, that you can carry it forward indefinitely, and it can be a good strategy, especially for younger people who are starting out and have an expectation that they are going to ramp up quickly into a higher marginal tax rate. They may actually want to waive taking the deduction in the year that they make the contribution.
Okay. This is probably a big one too. Tips are not considered income.
They are, and they're taxable. And you have to report them.
That's right, yeah. And
regardless of how you receive your money.
I never get any tips from my clients. So I'm not worried about that.
But if you did, you report them as...
Absolutely.
Yeah.
Absolutely. If I did...
You would lead by example.
That's right. That's right. Here's another good one too here. Mothers are required to claim the children first.
Not necessarily.
Yeah.
Typically, now there's always exceptions to the rule, it's the person with the lower net income.
Right.
In terms of claiming the $2,000 child amount or the child care expenses.
Yeah, I mean, that's a good point too, because I mean, I think a lot of, you get parents, fathers, they don't think about that they're entitled to some of those credits, and that's what it affects if they don't claim that child, so it's not just...
And then also, there's some tie-ins to certain personal credits. For example, if you're a single parent and you're claiming the eligible dependent claim, it can tie into that as well. So like I said, there's various rules about the personal credits, and each credit has particular criteria that you have to respect.
Exactly. All right. I can claim a flat rate amount for my business mileage.
It would simplify things.
Yeah, that would make things a lot easier.
The rule is you need a vehicle mileage log.
Yeah.
You need to track your mileage. Now, I've heard so many stories about I use my car 90% for business.
Yeah.
Doesn't work that way.
No.
It's your total kilometers driven for business divided by your total kilometers for the year, which gives you the prorated amount, and then you claim 100% of your expenses that you have accumulated. Doesn't matter if you spent gas to go on a personal trip or it's your total expenses for the year for the car are prorated based on your business portion use.
That's right, yeah. And that's a big important thing to stress too, especially in my line of business. In Gord's business, we're on the road a lot meeting clients, so it's important to keep that log, because they can come and ask and see, let's see those miles, and you need to have documentation.
Especially if your mileage fluctuates quite a bit. Now, there are some scenarios where the person may have relatively stable mileage on a month-to-month basis, and there is an option where you can track it for a few months and then average it.
Okay.
But we always recommend keep your mileage log.
Absolutely. I second that. An interesting one here. If I work outside the country, I do not need to file a tax return.
Absolutely incorrect.
Yeah.
In Canada, you have to declare your worldwide income.
That's right. Yeah.
That doesn't matter where it comes from.
Nope.
And I also hear people say, well, I worked in the U.S., but I filed a U.S. tax return, so I don't have to file it in Canada. Wrong again.
Yeah.
Because if while you may have paid tax on that income in the U.S., you still have to report the income in Canada, but you can claim the foreign tax credit for the the tax that you paid, which would reduce or eliminate the tax here in Canada, depending on your circumstances.
Another interesting one here too. Mortgage interest is a tax deduction.
If you're in the U.S., sure.
Yeah.
Actually, it can be under certain circumstances. If you have income from business or property, and you use your property for business purposes, your mortgage interest can be deductible, but it has to be deducted against income from business or property. Right. But the average person who works and goes to 9 to 5 and comes home and has a mortgage, no, it's not deductible.
No, it's a shame. So if you do have a question, you can give us a call at 613-728-1001. And so we're going to keep talking here about some tax myths. Another interesting one, child support is a tax deduction.
Child support prior to 1987 could have been deductible, but after that, no.
No way. Let's see here. Hey, they're interesting ones.
I guess
Something
I'll
we've
throw
already
out a
cleared,
few.
so yeah, if you want to go ahead, sure.
One of the ones that I come up on here quite frequently in Ottawa is if I have a pension and our RSP is somehow going to be a detriment.
Yeah.
I mean, there are possibilities for people who have maxed out their RSP, seen favorable investment returns, that they could be in a higher marginal tax rate in the retirement than they were in their earning years. But that's not nearly as common as what people would want to believe.
Okay. Let's talk about deductions. What is there anything that comes to mind? People say they try and claim as a deduction that's really not deductible. Is there?
Well, there's a broad spectrum of different scenarios, but in a basic employment type scenario, you don't really have a lot of deductions.
Yeah.
It's when you have think of the deduction as a reasonable expense incurred with a view to earn money.
Okay.
So if you're incurring an expense for income from self-employment, from commission sales, or from investment, there are some types of expenses you can claim.
Okay. All right, so let's talk about charitable donations. How exactly does that work? If I donate to my church or charity $100 a month, so say $1,200 on the year, how does that?
Well, you can claim donation receipts for legitimate charities, and you always should check with the charity, make sure its status has not been revoked. Right. But in essence, a charitable donation, you get a 15% non-refundable tax credit on the first $200 and 29% thereafter. You are not obligated to use your donations in the year in which you make them. You can actually stockpile them for up to 5 years. Okay. And likewise, if you have a spouse and you are both contributing to various organizations, you have some options as to who's going to claim them. You can either or you can split them. Okay.
For you, Gord, in terms of using a life insurance policy for a charitable donation, how would someone go about doing that?
That's probably going to be a more complicated discussion than we'd want to cover on the show. Just if you are looking at that as a strategy, as a plan giving strategy, it would be best to be sitting down with a professional and talking about your entire estate plan and how that would fit in.
Okay, perfect.
I agree with that one. There's a lot of different issues there.
Yeah. Mm-hmm. Okay. Is there any kind of changes tax-wise coming up for 2013 that people should be aware of? Has there been any big?
There hasn't been a lot of changes, but there's some few minor changes.
Yeah.
The one that a lot of people are still not aware of that I find is the income splitting provision on the pensions. Still, a lot of people are not quite sure how that works. And the other one that was the renovation tax credit.
Yes.
People still think they can claim it, but it was a one-time thing.
Yeah.
Income splitting is a bit of a pickle in its own right. Mm-hmm. I have clients who come to me and say, well, I want to do income splitting. I say, well, okay, well, how do I do that? Well, there are two options. There's what we call before the fact, and then there's after the fact. Most people are familiar with the after the fact version, which is you do an artificial split of your